Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Berkshire Hathaway has been one of the most amazing companies for investors since Warren Buffett turned it into a holding company to reinvest cash flow into his best ideas. Millionaires and billionaires have been birthed out of smaller investments in that company. But that doesn't necessarily mean it's worth buying right now. I'm Jason Hall. This is A Smattering, and I've asked my good friend Tyler Crow to come on with me to talk about Berkshire stock and see if we can figure out if it's a cheap stock right now or not. Hey, Tyler.
Jason, this will be fun, right? And this is definitely one of those topics.
This is certainly one that's going to get a little bit obscure, hopefully not boring, but it's one that if you're interested in Berkshire, you're interested in investing, hopefully you find it really compelling. Tyler, let me start off with this. So we think about just from a share price perspective, and I want to use the B shares, BRK.B, because these are the ones that are around $300 a share at recent prices. These are the ones that most of us could actually afford if we wanted to buy a few, versus those A shares that at recent prices trade for around $458,000, which is about the median price of a U.S. home nowadays.
Yeah. Shares for the plebes like us.
There you go. So as a fellow plebe, let's talk about it again. So $302 a share, more or less. And if we look at that over the past 3 years, it's up pretty good. We're talking about 68% in gains. That's nice. But if you look at it from the recent high, which was reached sometime mid to late 2022, it's down about 16%. So if you think about discount from an all-time high, it might sound like it's cheap. Now, here's a question I have for you. Warren Buffett's number, a metric that he has historically rinsed about the company and trying to determine fair value, is price to book value.
Yeah. And it's coming to the point with Berkshire's business where it's really the only valuation multiple that is useful in any way, because the way that Berkshire's earnings, the way that it's free cash flow, all of the numbers that we generally associate with other businesses and ways that we value them, they've more or less been thrown out the window with Berkshire, to the point that book value is almost the only thing that is consistent year over year that we can actually make a relatively decent guess at what this company's valued at.
Let's start unpacking things a little bit. And let's start just with the top, with market capitalization, which is the number of dollars it would take to buy the company today. If you were to buy every single share, if you bought all of Warren's shares, you bought all of Charlie Munger's shares, all of the shares that keep going every year to the Gates Foundation, you bought them all and you own the company 100%, it would cost you $659.7 billion in round figures today. But I think it's important to understand what makes that number up. And it's a little bit different than your typical company, because when you buy a typical company, you're expecting to buy all of its assets can generate in future cash flows, right? That's essentially what you're doing. But you're buying those assets. And if you buy McDonald's, you buy all of McDonald's operations, plus the brand, plus the financial ties to all of the franchises out there that have contractual agreements to buy all of this stuff from you and share a percentage of the wealth. Now, with Berkshire Hathaway, Tyler, let's talk about some of the subsidiaries that are part of it, that are wholly owned.
Do we have that much time in this video? Because I would break it down into more or less the big three. That's the insurance business, which is the float engine that is where you end up getting this massive equity portfolio. Actually, sorry, four.
I said again, talking about
on the operating side,
the subsidiary businesses that Berkshire wholly owns.
Yeah.
There are this kind of the big three, right? Yep.
Yeah. It's insurance, which actually entails a lot of businesses. Geico is the largest one, but there's a lot of reinsurance businesses and indemnity. And there's multiple insurance businesses, but we'll just group insurance all into one. Then you have railroad, which is Burlington Northern Santa Fe, which is one of the largest, well, one of the only four left in the United States in terms of class one railroads. And then you have the energy portfolio, which is predominantly utilities. So you got those three big operating portfolios. There's some industrial manufacturing in there. There's some smaller building construction companies. You got See's Candies, you got Dairy Queen. You start going down the road, furniture companies, jewelers, and even obscure things. So is it New Oriental Trading Post, like a catalog company. I mean,
right?
it gets really granular
Brooks
really
running
quick.
shoes, my favorite brand of running shoes is a Berkshire company. So there's a lot of things that are in there, right? So you get all of those operations. And again, you said the big three are the ones that we talked about, plus all of those other smaller subsidiaries. And then the fourth piece of it, and this is an interesting one. So again, that number, that 659, almost $660 billion in market cap. Now, this is some caveats here for this number I'm going to give you and talk about the equity portfolio, because this has become increasingly a larger portion, a larger percentage of what you own when you own Berkshire Hathaway. And that's all of those individual stocks that are portions of ownership of all of the other companies, like, for example, Apple, American Express. We could name a litany of others that are in there, but that's roughly worth about $300 billion based on the market cap of those companies. But based on the most recent data we have about the portfolio, which is from months ago, which may or may not be true anymore. But anyway, making an estimate, we're talking roughly half the value of Berkshire Hathaway is in its stock portfolio, and the other half of it is in the companies that it owns, plus something that's not listed in either of those, and that's the cash and the treasuries that Berkshire has on its balance sheet.
$130 billion of that 600 billion is just cash. Then you've got 300 million in equity portfolio, and then you got operating. And that's why it makes it so hard to value this company, because how do you do it effectively? Do you do what's called a sum of the parts valuation, where you find comps to the big operating portfolio companies like Burlington Northern and the utilities, and then add that all together? You start doing things like earnings multiples, and it's hard to do that because of changes in accounting laws, where they now have to book even unrealized losses and gains on that equity portfolio. So throw that out the window, and then you start looking, well, we could do it on free cash flow. Not when a company's buying $60 billion worth of treasuries every year.
Because of where that shows up on the operating statement, it affects how it shows up as free cash flow. And the other part too is that free cash flow, Tyler, is not a useful metric for evaluating insurance companies, because so much of their income is generated from their investments and not from their operations directly. So all of those things together, this circles us back around to where we started, right? With book value per share.
Yeah, we took the really long approach of, we told you the answer at the beginning, and then we're just, we're going to go back to what we originally said. And that's where we land back at book value. The price to book value for this company is 1.4, which is pretty par for the course over the past decade or so on a tangible book basis. So if you want to start taking out like intangibles and the debt positions, it's at 1.8, which is actually a little bit lower than we saw across some times in the 2010s. So it gets back to your point at the beginning, where I look at those numbers and they say, I guess it's cheap, maybe, but not so much that like you're pushing over women and children to go to your broker and buy this thing.
And I think more importantly, and I want to end on this note right here, it's time to evolve, I think, when it comes to thinking about Berkshire Hathaway. As much as the company has changed and looking at creating value, you get back to the evolution that Buffett himself went through in the 80s. And that was, instead of trying to chase the cheapest stocks, find the businesses and just make sure you're paying fair price. And I think thinking about it that way, if you believe that Berkshire is still one of the greatest companies on earth, we've arrived at this is definitely a fair price to pay for the shares.